you really have to smile at the market's action in the last 2 days. I mean, yesterday, after the Fed announcement, where the market was actually up slightly prior to their announcement of the cut in interest rates of 25 basis points, the market sold off almost 300 points on the bell. And here we are today, and the market is up 200 points. And the volatility is really quite dramatic. And I would also say, and the reason why you have to smile is because it's very difficult to explain yesterday's 300-point sell-off and today's 200-point rally. I think we basically need to look through the rhetoric and basically look at what the Fed did. And basically the Fed lowered interest rates 25 basis points. And if we go back and think of the time period when they were raising interest rates, it was very measured, and they raised it meeting after meeting, a quarter of a point, a quarter of a point, a quarter of a point. And it's, I think, quite understandable that you would expect them to act with the same discipline and the same measured approach when they lower rates. The fact that Wall Street was looking for a 50 basis point cut as opposed to 25, and therefore the disappointment yesterday, I mean, you don't want to say that it was silly, but it is you have to wonder who's in control. And I clearly think that the Fed is in control, not Wall Street, and basically we should take our cue from the Fed. Bottom line is, when the Fed is in an easy mode, it is a positive for the stock market. Will they lower rates again? Perhaps. I mean, the issues are still there. Nothing has changed. And the Fed, in my opinion, will continue to lower rates at a measured pace, which would be 25 basis points, until they get to a level, until they get interest rates to a level where it starts to have some positive traction in the economy. This process could clearly go on for the first quarter, certainly the first half of 2008. So, bottom line is, don't fight the Fed, and I think that the stock market, as these actions on their part, the easing actions, continue to get traction, it should be both positive for the U.S. consumer and for U.S. industry and for the banking system. The other issues, though, which we need to continue to pay attention to, is oil. Oil is trading at $92 a barrel as we speak, up a couple of dollars today. And if oil starts to work back up towards this $9,500 area, it's going to get people's attention again, and it could be a negative for the market. We've only got a couple of weeks left in the year, in the trading year. My guess is you'll get some year-end gyrations and a lot of window dressing, but not too much direction from now until we get into the beginning of the new year and the beginning of January, when a lot of new pension money comes into the market, which should clearly be a plus, for the stock market.